Today's rally, you need to be a little bit suspicious and a little bit cautious on, because stocks are still irrationally being held hostage to the movement in the price of oil, for better or for worse. On days when oil rallies like today, you see stocks move up in a jerk-like fashion, and on days when oil's been coming down, obviously you've seen stocks plummet. So I think it's great to see better housing data, and I also think it's great to see stabilization in some manufacturing data. But at the end of the day, the stock rally is really maybe for the wrong reasons. It's on the basis of a hope for additional stimulus on the back of Draghi's comments, rather than the hope of better earnings. And if we look at company earnings right now, we're seeing revenues coming in light. Roughly 50% of companies are missing the revenue numbers. So we want to see that reverse. We want to see some of this overhang lifted from the market.
All right, you were referring to Mario Draghi, the European Central Bank, who had hinted of stimulus to come. What worries me about that, and you and I have gotten into this before, as we look at this oil and stocks joined at the hip thing, that's getting back to how the markets love their nicotine fix. They need a hit. They need government help.
That's right.
They need a central bank, having their back, which is weird for this once great laissez-faire capitalist crowd, that they can only go so far without someone picking up their sorry you know what. That's what worries me, that they respond to that and not to what would be other fundamentals. What do you think of that?
Well, I think that's right. And look, Neil, the overhang on this market has been Fed. It's been China. It's been oil. And obviously, with the weakness in the global markets and the weakness in the economy, maybe the Fed takes a back seat. Maybe they take a step back here, and they're not going to be quite as aggressive in raising rates. And we're obviously listening to the Fed comments to get a better sense from that.
Do you think that's the case? The Fed goes slow?
Yep. Well, I think the move at the end of the year was somewhat suspicious. It looked like the Fed was trying to appear that they were independent and not political. But obviously, ahead of an election, the Fed probably doesn't want to be aggressively raising rates to cause any kind of disruption to the market. And I think that probably lingers. Look, Neil, we all know that nobody wants the history lesson. The 8th year of a presidential term is typically not a very good one.
It's true.
But you also typically don't get recessions typically right before presidential elections. And the Fed certainly doesn't want to induce that. And by the way, when you look at housing data, rates are still low, relatively speaking, by any kind of historical standard. So even with that bump in rates are still incredibly low. The one thing I think that will affect housing as we look forward is we've seen a lot of money coming in from overseas. A lot of Chinese buyers have been coming in. A lot of foreign buyers have been pulling money into the United States, fleeing those other currencies and those other countries. That's going to stop. China's not going to let that money out so quickly in the future. So I think for luxury homes in a place like New York and Florida, California, Boston, you're going to see some of those luxury trophy buyers take a back seat. In some of the energy markets like Texas that have had very good housing numbers, they're going to be affected by the weakness in oil. So housing may slow even though interest rates are low, and I think that goes along with sort of the slow growth economic story right now. So that's we'll see more as the year progresses, and hopefully some of this overhang becomes lifted and we can do some bargain hunting for investors.
All right. You covered everything there, Larry. Way to go.